In August 2026, the global picture centered on a geopolitical stalemate. A standoff between the US and Iran had effectively blocked the Strait of Hormuz, threatening a critical channel for the world's energy supply. Domestic data supported the gloom. The July jobs report missed expectations by shedding 23,000 jobs, adding pressure to a tech sector already reeling from a sharp summer correction. This chart tracks the Nasdaq during that same window. Despite the compounding crises, the index surged 8.8% in just 4 sessions, pulling the S&P 500 into a steep rally. The sheer verticality of this move is an anomaly. Historically, a snapback of this magnitude is typically reserved for the immediate conclusion of a major international conflict. This raises a difficult question. Why did the stock market explode upward while the economic and global foundations were under such visible strain? Understanding this move requires a look at market plumbing, the internal mechanics of how capital is borrowed and moved through the system. This bar chart shows the buildup of margin debt, money borrowed by investors to buy stocks. By June 2026, that debt reached a record $1.5 trillion, with much of it levered into AI infrastructure plays. That leverage created a massive pressure point. The catalyst for the summer drop was a fund called Situational Awareness, which held $45 billion in exposure and faced immediate margin calls when its AI trades began to slip. As the fund liquidated its positions, high-frequency algorithms sensed the falling bids and widened their spreads. This triggered a chain reaction of automated selling that forced prices down across the entire technology sector. The summer crash was a mechanical failure of leverage. Once that forced liquidation cleared, the market was no longer being weighed down by a cycle of margin calls. This dual line chart captures the divergence. While the red line shows retail prices falling, the blue line, the big money index, remained at 68. The combination of cleared leverage, strong Q2 earnings, and the anticipated Fed pivot created a vacuum that allowed the market to surge the moment the selling stopped. Capital first rushed into traditional safe havens. Gold and silver ETFs surged as the anticipation of lower interest rates weakened the US dollar. Retail optimism then flooded into the space and defense sectors, driven largely by performance at SpaceX. The rally was accelerated by a SpaceX insider lockup expiration, which instantly unlocked $100 billion in share value and drew a massive influx of retail capital back into the tech ecosystem. Investors were targeting sectors that benefited directly from the expected shift in interest rates and high-profile retail hype. Scientists use the term quench to describe the moment built-up pressure in liquid helium is released, causing it to explosively expand. The August rally was a market quench, a rapid release of capital out of fear and back into growth. This diagram tracks that rotation. You can see how capital drained from defensive utilities and flooded into materials, enterprise software, and financial firms. This volatility fits the historical midterm election year pattern. Seasonality typically creates a difficult summer before transitioning into high-probability gains in the fourth quarter. The Atlanta Fed's philosophy suggests that reacting to aggregate, lagging headlines will often lead to a misunderstanding of the current economy. By the time a jobs report is published, the market's internal mechanics have often already moved on. The stock market functions as a system of capital flow. In August 2026, the movement of that capital was dictated by the clearing of debt and the search for new yield.